Chapter 23 Summary. The master budget is a static budget, which means it is prepared for only one level of sales volume. A variance is the difference between an actual amount and a budgeted amount. A flexible budget summarizes costs and revenues for several different volume levels within a relevant range. An income statement performance report is prepared at the end of the period to measure actual results against the flexible and static budgets. A static budget variance occurs because actual activity differed from what was expected in the static budget. The static budget variance is divided into two variances. The flexible budget variance arises because the company had different revenues and/or costs than expected for the actual level of units sold. The sales volume variance arises because the actual number of units sold differed from the number of units on which the static budget was based. Most companies use standard cost to develop their flexible budgets. Standard cost is the budget for a single unit of materials, labor, and overhead. Price variances measure the difference in actual and standard prices. Efficiency variances measure the difference in actual and standard quantities used. Standard cost variances for direct materials and direct labor are each split between the price variance and efficiency variance. The price variance measures the difference between actual and standard price for direct materials and labor used. The efficiency variance measures the difference between actual and standard usage for direct materials and labor based on standard prices. In analyzing each variance, management must consider the overall effect of each decision and how it affected overall results for the production period. When companies utilize standard cost, journal entries are made using standard costs and variances are recorded at the same time. The variances are then shown on a standard costing income statement to highlight variances to management and more efficient decision making.